Okay, folks, welcome back. Your next quiz is a week from today, so I'll send out the review session. It's already on the webpage, but I'll send you the link. It's so if we can't make it again, it's the 10% will get moved to the final, not backwards. The reason I bring that up is there is this strategic question you're facing if you did really well on the first two quizzes. Let's say you got 10s on the first two quizzes. Now, you're saying, can I help myself by taking the third quiz? You can't hurt yourself, right? If you have two 10s, you could probably skip the third quiz. There's going to be no effect. But if you have a 9 and a 10, you cannot hurt yourself by taking the third quiz because the worst that can happen, it gets tossed out. The best that can happen is you do so well that you move the 9 a little higher. Because remember, it gets replaced by the average. So I'll leave that strategic choice up to you. It's not mine to make, but I would strongly recommend that even if you're not planning to do the third quiz, that you prepare as if you were, because you will need that material for the final exam, which is a couple of weeks afterwards. And it is focused. It is going to be just on capital structure. I know it's just on capital structure, it's still 150 pages, but still it's just capital structure. So let's build on what we were talking about, designing the perfect debt. So what do? You start with your company, you take a typical project and you ask yourself, how can I design debt that behaves just like my business? And again, the objective is it's not magical. Basically, you can make your cash flows and your debt go up and down as your operating business cash flows. It increases your capacity to borrow money. It reduces your cost of debt. And overall, it makes your firm less risky, less likely to be facing that truncation risk. And I ended the last class with an example of a security that was designed, I think, specifically to fool the ratings agencies. Remember trust preferred? Fixed dividend, tax deductible, loss of control. It's obviously debt. You got to credit the bankers who managed to convince. I mean, I'm sure it's a group of bankers who invented it, and the parentage is still kind of murky as to which particular bank invented it. Came out in the late 80s. By 91 or 92, they'd convinced the ratings agencies to treat it as equity. Huge win, right? And for the banks, it was a huge win because now you could go to companies and give them what seemed like the best of both worlds, which is you can borrow money, you can get the tax advantage, and while you do it, the ratings agency will actually be raising your rating because they think you're issuing equity. I can't lose. And what did the banks get out of this magical invention? They got fees that were much larger on trust preferred than on straight bonds. So everyone wins, right? At least for the moment. So if you went to work for an investment bank in the corporate finance portion in the early 90s, there had been tremendous pressure on you as the banker at the low end of the totem pole to sell trust preferred to everybody who came in through the door, including the FedEx guy. Would you like some trust preferred? Why? Because the fees were much higher. So let's suppose you're the banker at the low end of the totem pole. You can't change the game. So in a sense, you've got to kind of do the best you can. You've been told you have to sell a lot of trust preferred to companies as a security they want to issue. But you want to do the least damage you can along the way. I have a very simple question. Two potential clients who walk in through your door, both wanting to raise money. They're both companies that are at the very edge of their debt capacity. They're fully levered. They're optimal already. But one company is their debt ratio they accept, but one company is holding back from moving its debt ratio up because it is a rating constraint. They have the cash flows to service the debt, but they don't want to drop below a single A rating or whatever their internal rating constraint is. The other company doesn't want to borrow money because they just don't have the cash flows to service the debt. Which of these two companies will potentially create less damage to itself? Or which of these two companies would you advise to take the trust preferred? The company that's holding back because it is a ratings constraint, or the company that is holding back because it is a cash flow problem? The rating, and explain to me why the rating over the cash flow problem.
cash flow, they're in real trouble, they won't be able to serve.
In other words, you can fool the ratings agency, but you're going to get defaulted anyway, and that's not a win in anybody's book. What I'm trying to say is this is not a game. If you don't have the cash flows to service debt, I don't care how clever you are in creating something that looks like debt or hiding your debt, it's going to catch up with you because you have a cash flow problem. But here's what happened to trust preferred. 92 treated as equity, companies issue it. By 96 or 97, companies were starting to blow up because people were selling trust preferred to everybody coming in, including the people with cash flow problems, which means eventually the problem becomes real. So what did bankers do? Rather than accept this is not a good thing to do, they said the problem is we haven't, it looks too much like that. They've caught on. We're going to create something even more separated so we can, so the battle became one of creating more and more complex securities where the ratings agency wouldn't figure it out until later. I mean, the way to think about this is when you borrow money, it shows up on your balance sheet, right? Everybody knows you borrowed money. If you can create degrees of separation between you and the borrowing, it becomes more and more difficult for people to find out that you've actually borrowed the money. So you create 2 degrees of separation. Think of trust proof. Then you create 3. With each one, you're creating more and more separation. And you're in a sense fooling the ratings agency because they don't see the debt. The problem with this, if you push this to its limit, you create enough degrees of separation, you get to a point where the company borrowing money doesn't know that it's borrowing money. Do you think? No, do you remember? I've never quite figured out the answer to the question. If a tree falls in the forest and nobody hears or sees it fall, did it actually fall? This is the kind of question I think they treat in philosophy classes. It's been entire. I mean, I remember listening to this guy about Schrodinger's cat for 30 minutes. Finally, I wanted to put the cat in the microwave and just blow it up. I'm sick and tired of these mind games. But if you borrowed money and nobody knows you borrowed money, have you borrowed money? Yeah, there's one person who knows, right? Who? The guy who lent you the money. If you create enough degrees of separation, I think you get to a point where you actually have no idea how much you borrowed. And that's an extremely dangerous place to be. I know by now we know that Enron was an accounting scandal, but I'm convinced that in 1999, if you walked into Andy Fastow's office, and Andy was the CFO of Enron, and asked him how much money does Enron owe, he wouldn't have been able to give you the answer. Because what they'd done was create special purpose entities. That's how they created the separation to borrow the money. So on their balance sheet, you'd actually didn't see the debt. It was in the special purpose entities. And they'd created such complex separation between themselves and those entities that they had no idea what was going on there. So even if there were no accounting scandal, all you need is a downturn and all of this debt to come to you. And you say, I didn't realize we owed $6 billion. Banks need to remember this as well, because they play this game not with ratings agencies, but with the regulatory authorities. I mean, we talked about Credit Suisse creating debt that essentially is loose or flexible enough that it gets treated as equity. Amazing. You fool the regulatory authorities, but ultimately you got to be a healthy bank. So I'm not saying that you shouldn't try to create these complexities in one, but you have to know when to stop. You have to know why you're doing it, and you have to make sure you still have the cash flows to service the debt, because otherwise, eventually it's going to blow up. Let's see where we are. You've designed the perfect debt. You've got the tax okay. The tax lawyers have signed up. You've made these different groups with very different interests, at least not happy, but not unhappy. They're okay with it. You get ready to issue the bond, and you notice a problem. And here's what the problem is. Nobody will buy your bonds. You've designed the perfect bond. Yes.
Just because of the Zoom, I don't know they hear.
Can you guys hear me? They should be hearing me.
Yes, we can hear you.
Good. Thank you. So now you get ready to issue your bonds and nobody will. You're saying, why not? First, it might be the first time you're issuing bonds. You have no history with the bond market. You might have had a long history with the stock market. Remember, most technology firms are 20, 25 years old before they issue debt. But you've never issued bonds. People are not sure what to make of you. That's one problem. The other is you have a history with the bond market, but it's not a good history. Remember, we talked about the Nabisco effect, and we created the Nabisco, don't get Nabisco component funds. RJ Nabisco, in a sense, defaulted on its debt effectively in 1988. When they did that LBO and existing bondholders took those big losses, it went private, KKR took it private. 5 years later, RJ Nabisco came back to the market and it tried to issue bonds. And that did not go well. You see why? Nabisco bonds and bondholders said, we remember what you did to us last time. We're not buying those bonds again. So saying, what do we do then? I've designed this perfect bond. It's getting me the tax advantage. I've got everybody on board, but nobody seems to be buying our bonds. The question is why? And they don't trust you, right? So what do? You sugarcoat the bond to make it acceptable to bondholders. Let's look at some of the things you can do. In the late 80s, after the Nabisco fiasco and the LBO, a lot of smaller companies found it difficult to issue bonds because people said, well, what if you do a leverage buyout and our ratings collapse after that? And you don't, because we saw what happened in Nabisco. Merrill Lynch invented what were called rating sensitive bonds. And the coupon rate on the bond would actually change if your rating dropped from AA to BBB. If that had been around for the Nabisco bonds, you'd have been okay, right? Because the rates would have been adjusted. More bonds became convertible bonds. And you can see why. If you're worried about equity investors ripping you off, you put a conversion option into a bond, you're creating equity in your bond. So what you're doing is you're sugarcoating the bond. And whenever you see a bond with all of these special features, remember, it's not because a company is feeling generous and wants to give you these features. They're doing it because that's the only way they can get the bonds issued at a reasonable interest rate. So you've designed the perfect bond, you got the tax okay, you got these different groups working. And to the degree that people can't observe your cash flows, they don't trust you, you try to create protections. And I'd like you to think about, remember I said technology companies have trouble borrowing money, even if they're making, because lenders can't see what they're lending against. Think about creative ways you can get around that problem where you can tell lenders, look, we will give you a way to observe what's going on in the inside. It's not as easy as somebody with physical assets. That's a sugarcoating of the bond so that you get a reasonable interest rate. And then you get ready to issue the bonds. And there's a final stop you got to make, which is make sure you're not locking in market mistakes that work against you. Let me explain. You have a bond rating as a company. Let's say your bond rating is BBB. That's what Moody's and S&P have given you. But based on your assessment of your financial conditions, you think you should really be an A+ rated company. You think they've underrated you. Remember, you're at the last stage of the process, right? You went through your projects and you figured out that the best debt for you was long-term fixed rate debt, and you're going to issue the bonds. But right now you're rated BBB, but you should be rated A. You think you should be rated A+. If you issue those 30-year bonds or 10-year bonds or 20-year bonds today, think of what's going to happen. People are going to price these bonds as if you're a BBB rated company. They're going to pay you a lower price than they should. You're leaving money on the table, right? Because you're locking in a market mistake that works against you for the next 30 years. That's a scenario where you might be willing to use bridge financing, short-term debt. And during that period, when you have the short-term debt, what do you try to do? You try to convince the ratings agency that they've made a mistake. It might not work, but that's a market mistake working against you. But what if the mistake is going in the other direction? You know what I'm talking about? You really should be rated BBB, but they gave you an A+ rate. What are you going to be tempted to do as a company? Go out and borrow as much as you can. It's actually interesting if you think, I mean, this is true for bonds. Is it also true in equity markets? If a stock is tremendously overpriced, you're going to be tempted to go out and raise as much as you can. And every time there's a boom in a sector, somewhere along the way, I will get some CFO calling and say, look, Now, our stock is trading at 85, I think, and should be trading at 35. The conversation has to stay between you and I, because obviously CFO can't say this. And the question he or she asks is a very simple one. We really don't need, so let's take a condition. You don't need the money right now for projects. Should I go out and issue shares at $85? No, I'm not fooling anybody. It's completely legal to do so. And raise as much money as I can. What should your response be if you're in a company, the price is well above what you think the fair value is, and everybody kind of knows it in the company. You don't need the cash. Should you go out and issue as much as you can at that higher price? Okay, I got a yes and a no. So tell me the reason for the yes.
Issue at a higher price, and later on you sell it at a lower.
Okay, so when you issue at the higher price, what have you done? So who have you enriched? Remember, this is not your money. Somebody is getting richer, somebody's but remember, you're two equity holders. The new equity holders are bought in at 85 and the old equity holders were around. So you're enriching the existing equity holders at the expense of the new equity holders, right?
Exactly.
Yeah. And so I want you to be, that's perfectly okay, as long as the new equity holders don't start outnumbering the old equity holders, in which case you will have a problem a year or two from now when the equity, if you're right, drops back.
The way I look at it is at that point in time.
But you got, do you plan to leave as a CFO by the end of the year? You could, but that could play a role, right? If you plan to be CFO for the next 20 years, you're thinking about what will my shareholders meeting look like 2 years from now, 3 years from now. But this goes back to tenure, and because when people say managers think long term, not necessarily, right? Managers think about what will make them better off in the next period. And this is a scenario where somebody who's a long-term, let's say it's a family group company, it's a publicly traded, and the CFO is a family member. They're stuck with this company in the long term, and they might hold back, but you can see why you can get very divergent decisions, because if you issue the shares at the higher price and the price drops, you're going to be held, whether it's fair or not, as a reason the stock price dropped. You can frame it any way you want.
And all of these record IPOs would generate the same, right?
Well, IPOs are different in that sense. You're not issuing equity for the second or the third. It's different, I think, if you're a public company. In an IPO, there is a wealth transfer. What's a wealth transfer? Who are the existing owners?
Well, the new equity holders are transferring wealth
To the VCs,
founders or
and in a sense, if you issue at a high price and the price collapses, you do get a huge amount of blowback. It's completely legal, but there at least the argument you might be making is we're going public for the first time. We didn't know. Remember, the offer price is actually set well below the price at which it opens. So when you see companies being priced at incredibly high prices, so the VCs will say it's not our fault. We actually price these companies at $30 per share, but you guys came in and bid this stock up to 84 on that opening day. There, the wealth transfer is not necessarily to the VCs, it's to those people who are able to get the shares. Remember, the way you get IPO shares is you have to apply for the subscription, you get given shares at the offering price. So there is a wealth transfer there, but it's between not necessarily the old owners, but between these two players who got the shares. But it does, wealth transfer is a real issue in companies. And one way to think about what should I do is to think about who's benefiting, who's paying for this, and how will this play out over time. So I don't have a clean answer to the question, because it depends on, hey, what's your end game here? What are you trying to do? Do you plan to come back to markets? Again, that's the other issue, right? If you need capital in future years, are you poisoning the well by going out and issuing shares when prices are really high? Will it affect your capacity to raise capital in the future? Yes.
But does that mean like, so every time as a company, we want to issue new equity new share, we first look at our stock price, see
And the value per share. It's not a question of stock price, right? You need to have a sense of the value per share. Warren Buffett effectively has made this a precondition for buybacks, right? Which is, I won't buy back shares if the price, but there, the reason he has credibility is the guy knows something about intrinsic value. So when he says, I think the intrinsic value of Berkshire Hathaway is higher than the price, people listen. To be honest, most CEOs, have no idea what the intrinsic value of their companies is. So even when they make this conclusion, it's a noisy conclusion. They might decide their stock is overpriced, but they really don't have any control over that process. Yeah.
Ignoring the wealth transfer, shouldn't the CFO stick to seeing how the cost of equity would improve with this new emission? And how it compares to the
But
current.
issuing shares at too high a price has no effect on your cost of equity. It just, the cost of equity is the cost of equity. When you issue shares, it's a wealth transfer effect where you're issuing fewer shares. If you need the capital to take projects, it's a no-brainer. You should issue the share, even at the higher price, because you said, look, I need $3 billion to take a project. The fact that you guys are overpricing my company is not my problem. I have to raise the shares then. So if you need the money for projects, I have zero qualms about going out and issuing the shares, no matter what the price is. But if you don't need the money, you're just raising the money because the shares are overpriced, then it becomes much more, you become more susceptible to be challenged. So why did you guys do that? You can't even use the excuse that we needed the cash. You raise the equity, it's sitting as a cash balance there. It seems like you did this just to exploit the existing or the new equity investors, the people coming into the company. And that's why I think the argument against CFOs gets stronger when you don't need the cash than when you do need the cash. So you can play out the cost of equity, cost of capital effects, but this is not being done to lower the cost of capital. It's being done because you think the share price is way above that. So let's don't even look at, yeah, go ahead.
In that scenario, why don't you take like acquisition?
We do. That's the other thing you do, right? Because acquisitions in new shares, but your excuse there is, look, I'm buying a company. I needed to buy the company anyway. The fact that you guys accepted fewer shares than you should have is your banker's fault, not mine. No. So there again, you can make the argument. I have to go out and do acquisitions. If you're doing acquisitions just because your share price is high, then you're entering into some dangerous territory, right? Because you're doing the acquisitions because you think this is cheap money. There, I would advise you slow down, because this is eventually going to blow up in your face, because odds are you're overpaying on those acquisitions and getting away with it because your share price is too high. But if your share price adjusts, those overpaid acquisitions are still going to be part of your company, and you got to deal with it. So this is what I think one of the messiest areas in finance is when companies see their stocks get overpriced or shares get overpriced. You know, if their shares get underpriced, you have the opposite problem, right? Which is, even if you have good projects, you might choose not to take them because the project might have a positive net present value, but if you issue the shares at that low price, you're effectively transferring wealth from existing shareholders to those new shareholders, or in the case of an acquisition, to the target company shareholders, and that might more than offset the net present value gains from taking the project. But all of this is built on the premise that you can estimate a value per share for your company. So we'll come back to that as the last step. Yes. There is a downside for some companies, but remember the other things that have to come in place. It's small enough to be targeted, probably historical performance that is below their peer group. So if all of these things come together, there is clear evidence you're much more likely to be a takeover target. So it's not just having the cash balance, those other elements also have to play. So don't try to look at this page. I try to fit too much in. These are the last 5 pages on one basically summarized in one page. Designing the perfect debt, you start with your business, the type of projects you have. You design debt that matches up those projects. You make sure you still get the tax benefits. Otherwise, all this work is down the drain. You make sure you have ratings agencies, equity analysts and stockholders and regulatory authorities, if not cheering for what you're doing, at least going along with what you're doing. You sugarcoat the debt if you need to make it more acceptable to bondholders so you can get a reasonable interest rate. And then finally, when you get ready to issue the bonds, make sure you're not locking in market mistakes that work against you. This is something that companies should do themselves. I'm convinced that this is something you cannot outsource to bankers and consultants. 2 reasons. One is they really shouldn't understand your own business better than you do. If they do, you have a bigger problem. Second is they have other incentives. It's not that they're dishonest people or doing something that's bad. It's they have their own interests to take care of, and what their interests are and your interests are might not converge. So if nothing else, even if Goldman Sachs is coming in tomorrow to give you advice on what kind of debt you should issue, maybe you need to spend the next 24 hours as the CFO thinking about, hey, given what I know about my company and my projects, so in about 3 weeks, I'm going to go talk to the Mets. I'm a Yankee fan. I'm going to wear my Yankee cap and I'm going to talk to the Mets. And it's going to be a corporate finance session, so it's going to be fascinating. I worked on this yesterday afternoon. And you know what the stakeholders look like for a Major League Baseball team? There's the owner, which in the case of Mets is one man, Steve Cohen. There are lenders to the extent, but they're fans, big stakeholder group. There's a city that you're in. There's the MLB because you're part of a franchise. The MLB imposes constraints. So actually, if you think about keeping all stakeholders happy, you can already see that it's just as impossible for the New York Mets as it is for, and in fact, it's probably more difficult, right? Because the things you need to do to keep the MLB happy might not be the things that make your owner happy. And the things you need to do to make your owner happy might not be things that make your players happy. Because remember, that's another stakeholder group. And one of the things I want to bring up to them is if you borrow money and you want to design the perfect font for an MLB team, what would you do? And I want you to start thinking about this, professional baseball, any professional sports. If a professional sports team needs to borrow money, but before they borrow money, I'm going to point out to them how heavily levered they already are. By doing what? A professional sports team is incredibly indebted even before it borrows the first dollar. All those player contracts. And that's exactly what I'm going to do. I'm going to take all of the Mets player contracts. I'm going to take the present value of those contracts. And I'm going to ask him, does Steve Cohen know about this? Obviously he does, and he bought it in spite of it. But I'm convinced that professional sports teams should not borrow money because they're so heavily levered to begin with. But if you look at their debt ratios, yesterday I put up the debt ratio of the MLB teams, they're all around 0%. Looks like they're not borrowing money. There's some teams, I think the Texas Rangers have like 30% debt, which strikes me as insane that you'd add debt on. But maybe they don't have big contracts and maybe they can get away with it. But all of the lessons in corporate finance kind of kick in, even if you think about a professional sports team. So now I want to talk about specifics. We've talked about how to design debt in kind of general ways, but let's say you want specifics. If I say long-term debt, you say how long-term? And I say you should use some floating rate debt. So what percentage should be floating rate debt? I'm going to try to answer those questions using, basically 3 different approaches. The first is pretty intuitive, where I'm going to start with the projects you have as a company and try to reverse engineer from that and say, this is the perfect debt for your company. The second is, I'm going to take what we did in capital budgeting, where we looked at a project with projected cash flows and come up with a way of designing the perfect project debt for a project, given the cash flows. And the third is I'm going to look at your macroeconomic history as a company and use it as the basis for saying, hey, you should be using fixed rate debt or floating rate debt long. And there's a tremendous amount of information in that historical data. So let me start with the intuitive approach for Disney. Remember, Disney is a company, but it's in multiple businesses. And the right debt for the theme park business is going to be very different than the right debt for the movie business or the streaming business or any of the other businesses there. So with each business, here's what I start with. Let's take the movie business. A typical project is usually pretty short term, 3-4 years. Okay. I think Avatar took like a decade to make, but you can see why. But most movies, it's short term. And at least when I did this in 2013, the cash outflows tended to be in US dollars. Disney pays its actors in dollars. And much of its revenues was still in the US. That started to change, especially with the Marvel movies. The Marvel movies tend to do very well in Asia because they're action movies and they attract a lot more. So today, if I were looking at this, I might make a different decision. But in 2013, if I said, if I were designing debt just for the movie business, it's going to be short-term debt. It's going to be a mix of currencies if I'm attracting multiple audiences, but if the audience is primarily US, I'm going to make it US dollar debt. And if possible, I'd like to tie it to how well the movie does. For Disney, this is not something they should probably push for because they're a big entertainment company. But if you're Lionsgate, a company that lives from movie to movie, basically produce a movie every 2-3 years, you can see why designing the perfect debt and tying it to the movie's success is so critical, because you could think you're making the next blockbuster. You could be spending hundreds of millions of dollars and borrowing money to do it. But then if it blows up, it takes you down with it. So that's my movie debt. For the broadcasting debt, again, in 2013, the projects that they were looking at were likely to be short-term, primarily in dollars, though the foreign component was already starting to grow, and driven by ratings. You know what ratings these are? These are not bond ratings, these are Nielsen ratings. These were the days when, you basically look for ratings, and the higher the rating, the more ad revenue you made. So if you are designing the perfect debt for the broadcasting business, it'll be short-term, primarily dollar debt, and if possible, tied to how well that show does in the networks. For the theme parks, the projects are very long-term. You already saw 50, 60, 75-year projects. Currency will be a function of where in the world you're building the theme park and who the audiences are, the people coming into the theme park are. And finally, it is affected indirectly by how well your movie business is doing and your broadcasting business is doing. Consumer products, they were licensing these already, but if they were doing this from scratch, this is probably the easiest debt to create because the revenues are pretty predictable. You can issue debt against them. They're a gaming business, and if this were a standalone business issuing debt, it's probably the best candidate for issuing convertible debt, where you say, look, I'm going to tie the success. Now, Disney actually does not issue debt through its divisions, which means that the consolidated debt might not reflect those characteristics. But if you have standalone companies in each of these businesses, you can see the advantage of issuing debt tied to that business. Now, of course, Disney Plus is a very big player in the Disney component businesses. And I wanted to think about a general question. If a streaming company wants to go out and borrow money, remember, you don't have ratings anymore, right? Because it goes into the streaming platform and you're now looking to add subscribers. It's a messy business. We talked about how difficult it is to assess a project for a streaming business. Designing debt that somehow matches a streaming business is going to be a challenge. What should Netflix use as debt if your objective is to make debt whose cash flows move up and down with your business? Perhaps tied to users, subscribers, something to think about. But what you're trying to do is be creative in terms of what. So what I'd like you to do is take your company, even if it's multiple businesses, break the businesses down and think of what the right kind of debt would be for this company in terms of duration, in terms of currency, and there you can look at the actual breakdown of where the revenues come from. In terms of fixed or floating rate debt, what are you going to look at for that? What did we say drives that?
History
of how well you could deal with inflation, pricing power. So the question you're asking with the company, is my company the kind of company with pricing power? So how would I know? I mean, if you look at the business it's in, the competition it faces, you can already start to get a sense of pricing power, right? Airlines, I don't care how successful you are as a company, you don't have much pricing power. If you're a brand name company, you have significant pricing power. So think through it at least intuitively. And finally, whether you should be issuing straight or convertible debt, and that'll be determined by, are you looking at a growth company or a mature company? What do the cash flows look like now? What do I expect them to look like in the future? So that's the first stop, is just intuitively work through what the right kind of debt for your company is. Here's the second way you can assess the right debt for your company. If you can show me the cash flows you use to compute the net present value for a project, I should be able to actually tell you a great deal about the kind of debt you should use for the project. So in other words, we're using the project expected cash flows as the basis for also deciding what kind of debt is right for the company. So let me go back to my Disney theme park example. This is actually the Rio theme park with projected cash flows the next 10 years and a terminal value. So those are the actual cash flows. There's the present value, 3.3 billion. And that's where we stop, right? The last column hadn't shown up when we did the capital budget. We used the $3.3 billion net present value to decide this is a good project, we should be taking the project. I've added an extra column, and I'm going to do something that's going to look odd, but in a minute you're going to see where it's going to lead. I took the present value in each year and multiplied by the year it's in. So 922 times 1, 7 minus 730. So basically it's just the present value times T. And then I summed up that last column. I get 62.355 billion. You divide that by the net present value, you come up with 18.9 years. In foundations, did you do Macaulay duration on bonds? Did you talk about duration for bond? This is a Macaulay duration. Basically, the duration for a bond, you take the coupon, you multiply by T, you add up those present value coupon times T, and you divide by the actual value of the bond, you get the duration of the bond. I'm computing a duration for this project. Why is it so long? Because I have big negative cash flows up front, and my terminal values where my cash flows come in. I'm probably understating the duration of this project, to be quite honest, because my terminal value is actually forever. So if I put in 50 years for the terminal value, this probably get pushed out to 24, 25 years. What does it mean? If I'm issuing project-specific debt, project financing, where I'm going to borrow money against this theme park, that debt should be really long-term. To get a duration of roughly 20 years, the maturity of the debt has to be 30 years plus. 10-year debt is not going to do it. So if you look at the project cash flows, this is the kind of project where really long-term debt makes sense. So if you can give me the cash flows you use in project analysis, I can tell you what the right kind of debt from that is. But think of looking at a company from the outside, as you and I are doing right now, right? This is a made-up project. When you look at your company, you don't have access to project cash flows. You can't do this. So here's the second way to think about the perfect. So if you can get the project cash flows, you can do that assessment. Here's the second way you can think about the perfect debt for your company. Look at your history as a company. What history? Look at your firm value over time, the enterprise value over time, right? Market value of equity plus debt minus cash last year, 2 years ago. I also look at macroeconomic variables, interest rates over time, inflation over time, real GDP over time. You're saying, why? Because you want to see how your company's value and operating income change over time as the economy gets stronger or weaker, as inflation goes up or down. In other words, you're letting the data back you up and you say, my company is a cyclical company. My company has pricing power. Let's see if the data backs it up. So in the case of Disney, I collected two factors. I collected the operating income for the company because it gives me a measure of how much you have available to make interest expenses. And I also collected the enterprise value of the company, which tells you what the market thinks about the company. And those numbers over time show a company that started small in 1985. And over time, you can see the buildup in the company, both in terms of operating income and enterprise value. Every year I computed the percentage change in operating income and the percentage change in enterprise value. So basically I'm getting a sense of what the company's been doing for the last 20-something years. I went out of my company's data and also collected data on macroeconomic variables. And I'll tell you the 4 variables I focused on, and you're going to see why these 4 variables come into play. First is I collected the change in the T-bond rate every year. So I got the T-bond rate and looked at how much it changed every year. The percentage change in real GDP every year. So what does that measure? And that number is a big positive number. The economy is doing really well. When that number is a negative number, you're going to get you have a recession. The third variable was a percentage change in inflation. In every one, I'm looking at the change because I want to see how the company response when inflation goes up and inflation goes down, not necessarily with the level of inflation. And in the final column, there's on the Federal Reserve site in St. Louis, it's called FRED, you can get what's called the weighted dollar, which basically is the US dollar, how it behaves on a trade weighted basis against multiple currencies. Otherwise, I'll have 8 different currencies here, dollar, euro, dollar. So this allows you to get a consolidated sense of how did the dollar do during that year. So if you get a negative number, those were years where the dollar weakened, and positive numbers are years where the dollar strengthened. So here's what I'm going to try to do. I'm going to take each of these 4 variables and separate them, because if you put them all together, they're a mess because they're all correlated with each other. And with each one, I'm going to ask a question about how did Disney's operating income and value respond to changes in those variables. So I'm going to start with interest rates. As interest rates go up and down, how sensitive is Disney's operating income and value to changes in interest rates? Then I'm going to look at inflation. As inflation goes up and down, how sensitive is Disney's? That's going to tell me something about pricing power, right? Because if your operating income can go up as inflation goes up and go down, how as the economy weakens or strengthens, is Disney's operating income and value affected? That's going to tell me something about how cyclical my company is. And how as the dollar gets stronger or weaker, is my company playing out? Because I can tell you stories of how a stronger dollar can help Disney in some businesses, but I can also tell you stories of how a stronger dollar makes it less likely that people will fly into Disney World from Latin America or into Disneyland from Asia, because the stronger dollar makes everything more expensive. So let's start with the interest rate question. I'm going to look at how sensitive is Disney's operating income. So I'm going to ask it separately for operating income value, because I get very, slightly different kinds of information from those analyses. I'm going to run that regression of changes in value at Disney and changes in operating income against changes in the T-bond rate. When I run that regression, the output from that regression is actually going to tell me something about the duration of Disney's assets. Sounds like, how is that even possible? But when you look at changes in firm value against changes in interest rates, what you get as a coefficient on that regression is actually a rough measure of the overall duration of your assets. I'll back that up in a moment. So let's start by running a regression of changes in Disney's firm value. So that's 29 years of history I have against changes in the T-bond rate. First, before I get too excited, look at the T statistic. It's pretty close to zero. So the relationship, if there is one, is a very weak one. And I'm going to ignore the T statistic and look at the coefficient. It says minus 2.3251. How would I read that? Every 1% increase in the T-bond rate reduces my firm value by 2.33%. It kind of makes sense, right? Interest rates go up, firm value goes down. But you can already see that this is not the kind of company where the effect is explosive. There are some companies where you run this regression, you get an explosive coefficient, minus 15, minus 20. That's how sensitive the company is to changes in interest rates. So that coefficient basically is a measure of duration. And to back that up, I'm going to take you back to foundations. What's the duration of a bond? Give me a very simple definition of a duration of bond. What does it mean? Okay, there are two different answers and they're both right. One is, you said, it's
the average time of the cash flow.
in other words, it's a weighted average of when you get the cash flows. It's timed them. So if you have a long-term bond where more of the cash flows come in later. But you gave me the other definition, which is the percentage change in the bond price for a percentage change in the interest rate. It's actually the first derivative of the bond price to the interest rate. That's how the Macaulay duration was derived. That's how every duration measure is derived. You say, why are we talking about bond duration in the middle of a capital structure? What is the regression I ran? Percentage change in firm value against changes in interest rates. So in other words, I'm doing what you do in a bond pricing to get duration. I'm doing it differently by running a regression. So why couldn't I have done what I did with bonds, where you don't run a regression to get the duration of a bond. You take the actual cash flows and why didn't I do that for Disney? Because this is not a bond, right? They're expected cash flows. I have to do it for the whole company. So I'm using a shortcut here to get to duration rather than run the traditional bond duration where I take the coupons and the face value and compute that percentage change through that. I'm running a regression of changes in Disney's value against interest rates. And the coefficient in that regression, the 2.33, becomes my estimate of the percentage change in Disney's value for a percentage change in the bond. It's a duration estimate. The only catch is you saw the T statistic, right? It's an incredibly noisy regression. So on any individual company, when you run this regression, don't be surprised to see even a negative coefficient that the sign doesn't make sense, or a very low T statistic, because you're taking one macroeconomic variable and trying to make it explain percentage changes in a company value are all kinds. So this isn't a bond. A bond, you can isolate the effect, right? because your coupon is given. Here, your cash flows themselves might change as interest rates change, and that can affect the relationship. Sure.
What about the enterprise value? So you're using enterprise value
Yeah.
to kind of evaluate this, but isn't enterprise value, can it be affected by things like bonds?
It is, right?
Debt
Because what are the two?
debt is presented as equity, but it's really debt, and
But that's why you want to bring in debt, right? Because if I just stayed with market cap, then I'd be missing all that other stuff.
if they are not misstating,
Yeah.
but if they took debt, then
Yeah.
they are presenting as equity, right? Like what we were talking.
But
about.
won't the number, the percentage changes then give them away? Because they can play whatever games they want, but the market then adjusts the enterprise value based on what you actually have. So
You're assuming the market is like.
that's exactly right. And that's the other catch. You're letting the market tell you what the duration. If the market is making mistakes, your duration will also reflect those mistakes. So regressing changes in firm value against changes in interest rates for any company will give you a rough proxy on duration, with the catch that the T statistic is going to be timed. There's a noise problem. With betas, we had a noise problem, right? When you ran a regression of once, how did we respond to that problem? What did we do instead of using a regression beta? We used to bottom up beta. So one of the things I'm going to show you after I've shown you the Disney numbers is I've computed the average for this duration regression across all entertainment companies. That average actually is statistically significant because you're looking across a very large sample. So after I've done this for an individual company, I might replace the numbers you see in these regressions with those bottom-up averages, but I want to make sure everybody gets a measure of what exactly you're measuring when you regress this change in firm value against change in interest rates. I also, because I had the data, took the change in operating income and regressed it against change in interest rates. Saying, what is it going to tell me? It's going to tell me how sensitive my earnings are. I'm asking a different question, not about value, but about earnings. Why do I care about earnings? Because I need earnings to make interest payments. I can't make interest payments out of value. And here the relationship is stronger. It's negative. So every 1% increase in interest rates lowers Disney's operating income by about 7.9%. The T statistic is still not high enough to be statistically significant, but it's higher than it was with the firm value regression. So at least for Disney, the interest rate regressions don't yield an incredibly strong conclusion because Disney is a company that doesn't seem to be affected that much, at least based over its history, by changes in interest rates. The next regression is going to be much easier to read. I'm going to take changes in Disney's value and operating income and regress them against changes in real GDP. So you run the regression, you get a coefficient, right? If a company is a cyclical company, what should that coefficient look like? Big positive number, every one increase in real GDP, if it goes up, my income should go up. If my company is non-cyclical, I would expect that coefficient be close to zero because then and if my company is counter-cyclical, there are some companies which are, you can get a negative coefficient. So by looking at the coefficient, again, I'm trying to make judgments. Is my company cyclical or not to kind of get a sense at least whether my intuition about Disney works out. So I ran the regression against both firm value and change in operating income. Here, the T statistics are both significant. So the above 2. The coefficients are both positive. So what does that tell me? It's a cyclical company. Now, if I ran this for Ford, I will get much stronger coefficient, much bigger coefficient because even more cyclical. If I ran it for Kroger, you're probably going to get a coefficient close to zero because grocery store income is relatively non-cyclical. And if you took a bankruptcy lawyer business that's gone public, and you might get a counter-cyclical effect, which is the worse the economy does, the better you do as a company. So the coefficient on real GDP tells you something about the cyclicality of the company. Third stop, I looked at how Disney's firm value and operating income did as the dollar got stronger or weaker. Here again, the coefficient is easy to read. If it's a big positive coefficient, it means a stronger dollar helps you as a company. You make more money. Say, how can a stronger dollar help you? Because all your costs might be in other countries. So when you produce stuff in China and you sell it in the US and the dollar gets stronger against the yuan, your costs have effectively gone down, your margins have gone up. So that's an argument for a stronger dollar, increasing your value. Why would a stronger dollar hurt some companies? Because to the extent that you produce goods in the US and you're competing with foreign companies in markets where people compare prices, if you have a stronger dollar, effectively your prices went up relative to your competition. So you can make cases even within Disney for different businesses being affected differently by the dollar. So I was interested in what the composite company looked like. So I'm going to run a regression of Disney's firm value and operating income against changes in the dollar. And here's what I found. On firm value, the coefficient is 0.67. The effect is mildly negative. So if I were to read that, I would say firm value is affected. It's affected negatively by a stronger dollar, but not by much. If you look at operating income, the effect is much stronger. So if I were to take these two regressions and try to summarize them to Disney's management, say, look, your earnings are affected by a stronger dollar much more than your value is. And to the extent that you have any earnings-based things you want to do, like pay interest, you got to factor that into your decision-making. So a stronger dollar is more likely to hurt Disney, at least as a composite company, than to help it. Here again, you can think of companies where this coefficient could be a big positive coefficient. Maybe Microsoft, where much of the software is written in Bangalore and the cost might be in Indian rupees and their revenues are in US dollars. This could work out in their favor. Or companies where it can actually cut very severely against them and the dollar gets stronger because their competitive position gets weakened so much. Which leads me to my last regression, where I'm going to take Disney's change in firm value and operating income and regress it against inflation. Why am I doing this? Because I want to see how much pricing power Disney has, right? Intuitively, I'll tell you what I expected to find in the regression. This is called stating your price so that you know where I was coming from. Intuitively, I expected Disney to have pricing power. Why? Because I've seen what they do with ticket prices. They have a brand name present. They have the pricing power. So even before I run the regression, I'm expecting to see a positive coefficient on inflation. So inflation goes up, your earnings should go up. The value might go up. Now, the reason it might, you're going to very quickly see, even if earnings goes up with inflation, your value might not necessarily go up because your discount rates are also going up. But I was just curious what the effect would be. And here's what the output looked like. Firm value went up about 3% for every 1% increase in inflation. But the T statistic is, marginal. Operating income goes up about 8.19% for every 1% increase in inflation, and the T statistic here is significant. Disney has pricing power in terms of earnings. That pricing power doesn't translate into a higher value because your earnings might go up at the inflation rate if your discount rate also is going up, your risk-free rate goes up because of the same inflation, the effect is nullified. But that's still good news, right? Because most companies, the value actually decreases when inflation goes up because they're not able to raise income by enough to cover their discount rates going up. Disney, if it's not inflation helped, is at least relatively inflation neutral as a company. So if you're thinking about companies to buy now because you think the next decade is going to bring high inflation back, you're looking for companies which either have a positive coefficient in inflation on earnings, and even if you can't find a positive coefficient on value, at least a coefficient that's 0 or higher, because that means you're not being hurt by inflation. So the point of these regressions is to learn enough about Disney so that when I design the debt, I can design it with some numbers behind me in addition to intuition. But let me be very clear. These regressions are incredibly noisy. You're not going to get R-squareds of 30 or 40 or 50% for any company. Why? Because you're taking one macroeconomic variable. You're trying to explain changes in enterprise value. Think of all the things that you're essentially not bringing to the regression. Which is one reason when you look at these regressions, you got to kind of take a moment and say, look, I'm getting numbers, but I'm not going to get too crazy about these numbers. At the end of my Disney analysis, I looked at my 4 regressions and I said, if I were to summarize it, that Disney's assets collectively have a duration of about 2.33 years. And then I'm going to put 2 stars next to it since these statistics were a little weak. So you might not want to do anything crazy. That's increasingly becoming cyclical as a company. Why increasingly? Because when I broke the data down, it turns out that at the second half of the data, Disney was far more cyclical than the first half. Because as it went from being a theme park business to this entertainment conglomerate, it seems to have become more cyclical. Neither good nor bad, but something to keep in mind. It's hurt by a stronger dollar. at least collectively as a company. So individual businesses within Disney might be helped, but collectively as a company, a stronger dollar hurts a company. And it has some degree of pricing power in its income, which is protecting it even if inflation goes up. But all of these are built on regressions with low T statistics and terrible standard errors, right? So I'm going to do what I did with betas. Rather than stay with individual company regressions, I looked at what would the results would look like if I looked at all entertainment companies. So think of doing this regression for 50 entertainment companies and averaging out the coefficient on interest rates and inflation. These are so effectively the coefficients on each of the regressions. Remember how I computed the beta for a company? I took a weighted average of the betas of the individual business. It's exactly the same technique. But now I'm taking a weighted average of these coefficients, and what you get as a weighted average is my bottom-up estimate of what I'm concluding for Disney by looking at the entire entertainment business. And based on that entire entertainment business, it looks like the duration of Disney's assets is about 4.3 years. And now I feel more secure about this because the T statistic gets higher. It's mildly cyclical, which matches up to what we found with Disney. The typical entertainment company actually doesn't have much pricing power, so the coefficient is negative. And the typical entertainment company is also hurt by the dollar. So the only coefficient on which I get a sign change is inflation, where it looks like the typical entertainment company has relatively little pricing power, but Disney has pricing power. Now, remember, before I did all of this, I took a look at Disney's existing debt, right? We took the 4 companies. So once you do this, you go back and look at your existing debt and you ask the question, is my existing debt the right debt for me? So I took a look at so if you take the duration regressions, you expect the duration of Disney's debt to be about 4.3 years. Given that they have pricing power, you should expect to see a significant percentage be floating rate debt. And given that they're affected negatively by the dollar, by the dollar getting stronger, I would expect some of the debt, at least, to be in a foreign currency. That's what I'm expecting to see. Here's what I actually saw. Their actual debt had a weighted average maturity of 7.92 years. Remember, we used that to price Disney's book debt. That comes into play again. That 7.92 years works out to a duration of about 6 years. I'm at 4.33 years. I'm going to say, look, I have enough noise in my estimate. I'm not going to do anything crazy. But here's where you might do something crazy. If your duration of debt of the actual debt is 15 years and the duration of the debt you're getting from these regressions is 2 years, there is definitely enough of a mismatch that you're going to say they should have shorter term debt. Here, Disney's debt should be probably slightly more short term than the debt they actually have. They have about 5.5% of the debt in non-US dollar currencies. I would have expected to see a higher number. How high? Based on their revenue breakdown, about 18%. So it looks like they have too little foreign currency debt. And finally, on floating rate debt, they have about 5.67% of their debt be floating rate debt. But given what we saw with Disney's pricing power, I would expect that number to be higher. So the bottom line is I would expect the debt to be a little more short term, a little less dollar based, and a little more floating rate. So here are the tactics you can use to try to fix this mismatch. One is you can do swaps. Basically take some of their fixed rate dollar debt and swap it for floating rate foreign currency debt. It's easy to do. You can overnight fix the problem. But for Disney, I'm going to suggest an even lower cost option. They're continuing to take projects, right? They're doing new investments. They're borrowing money to make those new investments. If you use a disproportionately large amount of floating rate debt on those investments, guess what? You're going to be pushing up the floating rate debt of the overall company. So on their new projects, I would recommend that they use more floating rate foreign currency debt to fund those projects, even though that might not match the project because it helps the company get into a match in terms of its overall debt. So if you're looking at the end game for capital, for designing debt, start by looking at the existing debt. What does my company actually have? Then do an intuitive analysis. Does it make sense what they have? And then if you can, do the macroeconomic data. And you're going to find some noisy results, but maybe for some of your companies, you'll find something interesting in that macroeconomic data that you can build into your debt design. Now, very quickly looking at my other companies, here's what I concluded. For Bookscape, what they actually have is long-term operating. That's the only debt they have. They don't have traditional debt. But if you think about a retail business that leases stores and you want to design debt that's matched up to your investment, a lease is actually the perfect kind of debt for a retail store, right? Let's go through it. Its duration is matched up to the duration that you're going to have the store. It's in the same currency, obviously, as the currencies because it's localized. And you have the option to walk away and essentially, I mean, if the store doesn't do well, without putting your entire company at risk. There's a reason why leases have evolved as a primary way of financing for retail companies, because it actually makes sense as debt. It doesn't make sense for a company to go out and borrow a huge amount up at the top and try to borrow and buy stores. Leases actually tie your debt to individual stores with the option of being able to walk away. You have a question? Yeah. It turned out to be negative, but I'm going to override that. Yeah. And this is where I think the intuitive part will sometimes lead you to override any of the duration numbers, because in many ways, Disney is such a unique company in the entertainment space that I trust my intuitive analysis that their pricing power based on those numbers. Now for Vale, so what they have is what I would leave them, because the right kind of debt for them should be debt that's matched up to their store. Dollar debt looks like the lease does that. For Vale, their actual debt is in US, is 65% is in US dollars, average maturity of 14.7 years. It's long-term dollar debt. Now, if I were looking at their cash flows, I would expect the debt to be dollar debt. Why? Because it's a commodity company. It gets its revenues in dollars. I'd expect it to be long-term. Why? Because mines are long-term investments. You're saying, would I let it be floating rate? If I let it be floating rate debt, it'll float based not on LIBOR or on the T-bond, but it'll float based on what? Iron ore prices or whatever I can. So in a sense, you might want to tie it to the commodity if you really want. I mean, think of all the shale oil companies that found themselves in trouble in 2020 and think of how much better off they'd have been if they tied the debt. I mean, it's not a free lunch. You pay a higher interest rate, but think of how much less default risk you have if you can tie your debt to whatever is driving your earnings and cash flows. For Tata Motors, the actual debt is a mix of Indian rupee and euro debt. The euro debt comes from Jaguar Land Rover, the Indian rupee debt comes from the domestic company with an average maturity of about 5 years. And if you look at what the recommendation is, probably medium to long-term debt, the debt is probably pretty close to what I'd expect them to have. Now, and I would expect a mix of currencies. Whether the mix they have is the right one, I don't, at the moment, I don't have the information to do it because they, this was right as they were starting to break down revenues in Tata Motors and Jaguar Land Rover separately. But if they can give me a geographical breakdown, that's what I would compare it to. And at least in 2013, I thought they had enough foreign currency debt. Today, I'd expect them to have far more foreign currency debt than they did then because Jaguar Land Rovers continue to grow at a faster rate than the domestic auto company. And finally, in Baidu, this is my only company where I'd expect to see convertible debt because it's a growth company. And given that they get almost all of their revenues in China, I would expect the debt to be in yuan. Their actual debt is fixed rate debt. It's outside China. It's in a foreign currency. So this is the one company where there's a clear mismatch between what I'd expect to see. Does it mean that the company is exposed? I don't know what they're doing in terms, because remember, you can have mismatched debt and use derivatives to meet it. Maybe they are using futures and options to deal with it, but they have a mismatch problem between what debt they have and what debt I would expect them to have. Any questions on designing the perfect debt? Yes.
Do companies have to disclose those hedges?
They do, but the laws and disclosure tend to be kind of fuzzy on what you disclose. So they might say, look, we have foreign exchange hedges, but they won't tell you the dollar amount or what the hedges are. So it's kind of mixed. Some companies are very clear. They give you full descriptions. Others will just say we hedged against this, but not enough information to figure out whether they fully hedged against it. You know how you can tell? Is when they report their earnings, companies report earnings before foreign exchange losses. So if you have a company that constantly has to report earnings that are different, you know whatever they're saying is not true. There is a hedge that's incomplete, and you're seeing it in that extra volatility. So sometimes the data on the earnings volatility itself will give away whether they're actually hedged or not. I'm at least going to get started on the, so your third quiz is through that page. So everything we do after that will be on the final, but not on the third quiz. I'm going to start with a statement about dividends that is obvious, but might as well be made. I hear people talking about, oh, Berkshire Hathaway has a lot of cash. Apple has a lot of cash. Now, I want to be very clear. Companies don't have cash. They hold their shareholders' cash for them. And I wish that that were the default, because then when a company reinvests, it has to be very clear, it's reinvesting money that belongs to the shareholders. When it pays a dividend, they're not doing you a favor. They're giving you back some of your own cash. I hate it when companies act like paying your dividend, they're doing you a favor. No, you're not. That's my cash. You're just giving it back to me. I'm doing you a favor by letting you retain earnings. Think of how the power would be shifted if instead of you having to convince a company to pay more dividends or return more cash, the company had to convince you to leave cash with them. It'll give you a lot more power, right? It's not the case right now, but I want you to think in those terms when it comes to dividends. This is shareholder cash, and the question of what the right thing to do it has to be done through the eyes of the shareholders. So that lead in, there are two questions I want to address, at least set up and answer as we go through. First is, when I look at a company, I'd like to be able to answer the question, how much cash could this company have returned to its shareholders? In other words, I want to get a measure of potential dividend. It's actually one of the most simplest and most intuitive questions in finance to answer. The answer is right there on the statement of cash flows, but I'm going to use the statement of cash flows differently than an accountant does. An accountant uses a statement of cash flows not only to disclose the cash flows, but explain why the cash balance changed. I'm going to look at the cash flows with a different intent, which is how much could this company have returned? I'm going to call it free cash flow to equity. It's a fancy word for potential dividend. Next, I want to address a question that's increasingly become a question central to many US companies. So you have $2 billion available to return. You have three choices. You can choose not to return the cash and hold it as a cash balance. But if you choose to return it, you can return it either as dividends or by buying back stock. I want to remove the mystery about buying back stock. I'm going to argue that buying back stock is just flexible dividends. And the choice will vary from company to company as to which one is better for them. So to start the discussion, let's set up what dividends should look like if you followed logical sequence. Remember, dividends are residual cash flow. So they should be the last step in corporate finance. So if you're a company, what do you start with? You start by looking at your projects and you pick the best projects you can. And then you look at financing because you need the debt and equity to match those. And after you've taken the investment in the financing decisions, if there is any cash left over, and there might not be, you have to decide how much to pay in dividends. So in a logical world, dividends should be the last step in the process. But dividend policy is, I think, the aspect of corporate finance where you get the most dysfunctional behavior. Dysfunctional in what sense? Now, if you look at the roots of dividend dysfunction, they're built on this belief that once you start paying dividends, you cannot stop. They're built on this belief that if you pay dividends, people will pay more for your shares. So there are companies where this is deeply set. And in those companies, everything you do in dividend policy is driven by two things that they look at. Neither is based on logic or finances or that residual cash flow. It's based on inertia, which is, what have we done over history? Because we need to do the same thing. Now, I think, I don't remember, it's 3M, I think that's paid dividends 57 years in a row. There are companies that will actually boast about how many years they've paid dividends. They've never had a dividend cut. And there are some investors for whom this is an attractive feature, but inertia basically means you pay the dividends you always have. The other is you look at what everybody else is doing and you say they're all paying dividends. I need to pay dividends too. You're a bank. It's almost a given. Banks pay dividends. I have to pay dividends as well. The fact that your regulatory capital is in the toilet becomes a non-issue. So in a dysfunctional world, dividends tend to drive everything else, right? You make the dividend decision first, and then you go decide how much to borrow because you already dug a hole. And then after you've done that, you look at the project. So instead of dividends being the last step in the process, they become the first step in the process. So I'm going to start by stating some very simple facts about dividends that I want to put on the table. Now, some of these facts are about US companies, but I'll also extend it out to global companies. If you ask me to use one word to describe dividend policy in the US and in much of the world, the word I would use is sticky. You know what I mean by sticky? Most companies in most years pay in dividends what they did the previous year. In this graph, I have the percentage of companies each year in the US that increase dividends, decrease dividends, and do nothing to dividends. So the green is the increased dividends, the orange is the decreased dividends, and the gray is the do nothing to dividends in every single year. And I can go take this back to the 1920s if need be. The percentage of companies that basically paid the same dividend that they did the last year outnumbers the companies that changed dividends. So that's the first fact on the table. Now, most companies don't change dividends. That's the sticky part. And if they change dividends, they're far more likely, almost 5 times more likely to increase dividends than decrease dividends. Dividend increases vastly outnumber dividend decreases. But doesn't it depend on the year? To show you how sticky dividends are. Remember that first quarter of 2020 where the global economy shut down and people were talking about default? It was a period where people were afraid, companies were afraid, and should pay out a dividend policy, right? Yes, sir.
If I was a CFO of a company.
Yeah.
Would it be better for me not to pay a dividend rather than paying an increased dividend?
Is a cut in dividends to zero better than a cut in dividends to a larger number? Either way, you're going to be fired. Right? And here's why. Who are the people in your company? Who are the shareholders in your company? I'm going to make you put out a saying that I'm going to come back to. You get the shareholders you deserve. You pay large dividends. Guess who you accumulate as shareholders in your company? People are addicted to large dividends. Older people, pension funds, they build their portfolios around large dividends. Do they care about your financial condition? Maybe remotely. What's their first priority? I want that check in the mail. And what are you going to tell them? I'm going to cut that check in half or to zero. My first response is, you must be kidding me. You show me the free cash flow equity, show me the net income, and I don't care. I want my dividend check. So unfortunately, there's no easy win. This is why there's inertia, because even if it makes sense for you to cut dividends, you're afraid, you're terrified of what your shareholders will do to you. This year, when you look at banks, they should cut dividends, right? You're heading into what's probably more capital requirements. And Charles Schwab yesterday announced they're going to keep dividends at what they were last year. And Schwab is one of those companies that's come under the limelight of, could it be in trouble? Could it be the next Silicon Valley Bank? Is there enough? But you know what they scale back on? While they preserve dividends, they drastically scale back their plans. They'd announced a stock buyback 3 years ago. And they said, we're suspending that. That's why I describe buybacks as flexible dividends. You can cut buybacks to zero and you don't get punished, but you cut dividends, you get this blowback that you can't deal with. So when you think about buybacks versus dividends, that has to come into play. So even in bad years, and I have the same numbers from 2009, terrible year for companies. You'd expect companies to be cutting dividends, and more companies did cut dividends in 2020 then. But even in 2020 and 2009, terrible years for the market, terrible years for the economy, more companies increased dividends than decreased dividends. So typically that's 5-1, that year's 2-1. But if that's what happens in the worst years, more companies still increase dividends, that's a testimonial to how sticky dividends are. So dividends are sticky. Second, dividends tend to follow earnings. Keyword is follow earnings. They're not contemporaneous. They don't lead earnings. Yes, go ahead.
you're talking about companies that you end up cutting versus
Yeah.
adding dividends. I imagine probably biased towards companies that are distracted, not doing well.
Yeah.
But in the case that there are.
It's not just, so most of the time it is those companies, but continuing question.
I was just saying, if there are companies that have just decided to do that as a matter of policy, how does that affect them maybe in the longer term, other than their CFO fired?
Other than the CFO getting fired, it's a big deal, right? Because who's making the decision? It's the CFO. But I think you're raising a question, which is, and I'm going to come back and explicitly deal with this question later. Let's support, I mean, many of the companies that pay big dividends tend to be companies that were in regulated businesses, have stable earnings, like phone companies, right? All the phone companies had huge dividends because the phone business was a monopoly. Verizon's history comes from AT&T paying dividends because Verizon was one part of AT&T that was spun off. So it was, in a sense, they had a legacy dividend policy. But is telecom now a monopoly business? Is Verizon? Oh, maybe the broadband, but this is now a comparative, it's more technology than a regulated monopoly, right? So one of the questions I would raise next session is, hey, your business has changed from being this nice, stable, predictable business to a risky business, which requires a lot of reinvestment. You can't afford the dividend policy you have right now. How do you transition to a lower dividend? Or what can you do to make that transition? Because you need to make the transition because you continue to pay the dividends you did and you make your business riskier. You know what you're going to be doing, right? You're going to be paying dividends through one window, issuing equity through the other. It's a very expensive process. But I'm going to come back. There's no easy answer to the person making the decision to get the CFO. Because in the short term, people are going to punish you, no matter how well-intentioned your dividend cut is. You just have to hope you can ride out the storm. But I'll talk about techniques you can use to package your dividend cut to make it a little more palatable to your shareholders, and therefore you more likely to survive. Because I want you to be able to survive, because if you're not going to survive, you'll never make this decision, right? So I'm trying to sell you on cutting dividends. I've got to sell you on a way to cut dividends where you can cut the dividends and emerge on the other side intact because you made the right decision. Dividends tend to follow earnings. If they're not contemporaneous, they don't lead earnings. What does this mean? Say you have a company that has a really good, and the earnings and reports are starting to come out for the first quarter. We'll start to see some companies report much higher earnings than expected. Let's say it's a dividend paying company. So earnings go up, you say, hey, a dividend increase should go with it, right? The higher earnings. If earnings go up this year, don't expect a dividend increase right away. If the earnings goes up 2 years in a row, the odds have gone up 3. It might take 3 or 4 years of good dividend increases before a company, or earnings increases before a company can increase dividends. That's a lag effect. The way this shows up is when you track earnings and dividends for US companies, you can see that good earnings years are not necessarily accompanied by increase in dividends. It takes a while for dividend changes to play out. Conversely, a bad earnings year doesn't get reflected in dividends right away. The cuts might show up 2 years later, 3 years later, 4 years later, because that's when it catches up to you. So maybe the 2020 effect showed up in 2021. The 2009 effect showed up in 2011. That's a lagged effect on dividends. And stating the obvious, as an investor, when you make money on stocks, you can get it in the form of dividends, or you can get it in the form of price appreciation, capital gains. Do tax laws matter? Obviously. So if I tax dividends at a much higher rate than capital gains, companies will be less inclined, or should be less inclined, to pay dividends because shareholders will get taxed more. Conversely, if I don't tax dividends and I tax capital gains, you should see a lot more in dividends. So I'm going to take you back to 2003, which was a momentous year for dividend tax history, because from 1915, which I think is when the income tax was created in the US, was ruled constitutional first income tax, through 2003, for almost a century, dividends were taxed as ordinary income, which meant that if your income tax, the tax you paid on your salary, 35, 40%, you paid the same rate on dividends. Capital gains were taxed at a lower rate. How much lower? It was actually set at 40% of your ordinary tax rate. So your tax rate is 50%, your capital gains tax rate was 20%. If your ordinary tax rate was 40, your capital gains tax rate was, so there's a clear distinction. In 2003, as part of the Tax Reform Act that was passed that year, For the first time in US corporate history, the tax rate on dividends and capital gains was set at 15%. So both would be taxed at 15%. So you can see that, this is the tax rates now on dividends and capital gains are brought down. The only problem is to get this tax reform passed in the Senate. And I want to take you through the mechanics of the US Senate because that's kind of painful. They didn't have enough votes to overcome a filibuster, which is 60 out of 100. So they designed this tax reform act to pass with a majority vote. The only problem is with the majority vote, you have to put in, you can't, it has to be, don't take me, I don't want to go into convolution. They had to make it budget neutral. The only way they could make it budget neutral was to have it sunset entirely in 10 years. It's a terrible way to write a tax law, right? You write a tax law where the entire tax law disappears off the books 10 years from now. Their reasoning was, we have 10 years to fix the problem. Somebody will fix the problem sometime, right? But this is the US Senate. So this passed in 2003, up until 2012 to fix it. Guess when they turned to it? The last 2 weeks of December 2012. So you're 2 weeks away. So the last quarter of 2012, we still had uncertainty. Will the entire tax law disappear? In which case, dividends are going to go back to being taxed at 40%. Or will they stay what they are, in which case dividends will be taxed at 15%. So if you're a company and you want to pay a big dividend, guess when you want to pay it? You want to pay it before the tax law sunsets. So last quarter of 2012, you get this huge stream of special dividends and dividend payments. Why? Because people weren't sure whether the 15% tax. So every time you see these cliffs in the tax law, and the US tax law always has cliffs, you're going to see dividend policy kind of react to what's going to happen. What are my dividends going to be taxed in the next period? So it's something to factor in, is think about how dividends and capital gains are taxed in whichever country you're in, and you should be able to get some insight. In Argentina, how are dividends taxed? Or they're taxed? Does anybody pay taxes on dividends? I would assume somebody does.
At the normal rate, but now companies have to pay a surtax if they do distribute dividends.
So you penalize companies to pay dividends. So next session, we will talk about those corporate level taxes that sometimes get imposed, but we will kind of complete the discussion on dividend policy. So I'll see you on Monday.
But after 2013, it would you say,
Thanks. So they actually fixed it at a higher rate, raised it to 20%. It's actually 23.8% of your wealth. It's basically the 2008. Not in 2008. So every year the stock of making it ordinary. You'll finally get the whole thing.
Having case like this was sort of exactly. Maybe we can go for something like a time series of actions, which is what we got in this case, right? Let's put the data.
You could. Large and significant, very simple. That includes everything that affects the market. And we get our now with the macro regression, what happens is one aspect of how much and the total effect is 35%. No single macro variable is going to be able to accept.
Yeah.
So you can see that maybe by running it out, but I wouldn't be too optimistic that that guy was right the bar and make it.
Yeah.
But I
could maybe get more significance within the.
And you might, your coefficients might become more. It's not just a thing. I might have in the right duration, but I'm just simple regret, operating income against farm value, and we do time series.
And give you some forward-looking value as well.
And the problem with forward looking is this is a changing company, right? Our data, but the company itself is changing, so it looks like our 30 years of data. Actually, it's far less than that. The company the last decade has become so different from the company 20 years or 30 years ago.
Exactly.
So one of the problems with this is time series data with companies, the company itself is a moving target. Maybe a company,
Yeah,
Coca-Cola, you can get away
Yeah,
with it. But I can't think of too many companies, right, to look at a company, that company looks pretty much the same for the last 30 years. But then the 30-year data can give you much more value.
And has there been an attempt to capture that?
The changing business mix, the only way to do it is to go to the bottom up, right? Because there you say, look, and I give up. You're in multiple businesses,
enough.
I'm going to take each business and do this by the business level. It's the same reason we use bottom up betas, right?
Yeah.
I could take the regression beta, I could finesse it, I could play statistical game, but it's really one slice of history. That's your problem, right?
Yeah.
All the statistics you do, you still have one slice of history. Whatever happened in that slice is going to give you the outcome.
Yeah.
And if something odd happened, it's going to show up in your results. And the only way to get rid of it is look across as many companies as we can and let the law of large numbers kind of become your ally.
Awesome.
Okay.
Thanks so much.
I had a question related actually to that. When we do the bottom up data and also the bottom up calculation board, we're like relying on the law of large numbers for average, right? But doesn't that mean that the sample constituents that we're looking at, don't they have to be independent for that to
That
be
the
a
errors you're making on each company are independent. Because if you think about an individual regression, think about why it's not giving you the results you want, because things are happening in the company that are not.
aren't, let's say I'm looking at an industry, right? All these
But
companies in this industry,
it's sector wide, you want to capture.
you want to capture the correlation between these
Yeah,
companies.
because in a sense, you're basically saying, no, if they're
Oh,
moving
because you want
together.
yours to be.
Exactly, right? So in a sense, they're being driven by the same force. So let's say change in the media law, making all these companies become more sensitive to inflation. You want to bring that into inflation.
Okay.
Which is a very different outcome from the beta. The beta, we're trying to get, what does it diversify? Here you're asking a very specific question about how does that macro variable play out in the company?
But on the betas. Is
On the
that,
betas,
is
you
that
are-
the same reason? Or?
The beta, if you do it because I think there you are going to get granted against the market index. So whatever is not being offered, they're almost by definition can't be set to take a point. It's got to be company specific. The law of large numbers. But I'll tell you cases where it can, if in 2009, you look at that. The collective beta, so you can do the bottom of it, the beta is the bank went up because of the 2000 crisis. So you averaging it. If you argue that the 2000 crisis is the once in a lifetime crisis, never going to go back, you don't want to use the bottom of beta because it's inflated because it's all the
Yeah, of
banks.
course, once there's like an
But
event.
if you feel that this is now part of what you need to think about it, so you're okay leaving it and saying, I'm going to use a higher beta, even though it's much higher than it was. My industry averages change over time.
We should then take, let's say, an average over like 5 or
In fact,
10
for
years.
every sector, I mean, but then the case bank, when I do that, what am I saying? 2008 was an outlier.
And an outlier can happen again, but you want to take it on the right way.
And that's why I also look at the data, I report a 5-year average. It's an average of an average across 5 years.
That makes sense. And then I had a question about the sheet that we're filling out, the master sheet. There's a free cash flow to equity column there. I wasn't sure, like, this is just out of the cash flows, just that bottom line, basically?
No, we'll talk about that next session.
Oh, okay, I wasn't sure. And then there was also, like, the last dividend is just, right, what they paid?
Just
And-
whatever in the statement of cash flow, the dollar dividend. the
Yeah,
aggregate
exactly.
number.
That's what I
So
did.
I'll specify, prefer the numbers to be in millions, there will be dollar values, they'll come out of the statement of cash flows.
Okay,
Like, the computational free
Yeah.
cash flow equity comes from the statement of cash flow, but it's not the bottom line cash.
I understand. Okay, so then that means that also the last column we will do after that because it's like the value per share would be, okay, thank you.
Yes, sir. Regarding
that question you mentioned might do, let's say it's based in China, but there's the risk of actually occurring. So my question would be, do you think it will make sense, let's say, because China has like a weaker debt market, do you think that it's
It might be the reason they issue the bonds, in which case, what they expect them to do is issue the bonds and then fix the mismatches in the they are going to be. I can't issue that quantity of bonds. You shouldn't, knowing fully when things.
got it? Yeah, I'll take a look on that. And in terms of the inflation part, do you think it will make sense to like run the regression based on like valuation multiples against inflation?
But then when you price. Like you're capturing something like inflation goes up, the ratio goes down, not just for a company like our market.
Yeah.
As a company, corporate finance, there's nothing to learn from it. It's not.
Yeah. What about the EV over EBITDA thing?
That's really low on the interest rate curve because it's a curve of capital cost. So again, multiples is just going to get the effect of what is the across the board, not necessarily what it means to.
Got it. Awesome. Thank you so much. Appreciate it.
Literally, like, actually. Yeah. I don't know, something. But I find. Yeah.